Good morning, team. Today we will start with the second lecture on international financial management. So let's take up the questions which we were remaining to do. And if you remember in the last session, we had just discussed about the question number 6, which was about a multinational company. So let's take up this question once again. There is a multinational company which is planning to set up a subsidiary company in India where hitherto it was exporting. So the scenario is that the company was exporting till now, but now it is thinking that let us set up a subsidiary company in India because the product is growing as well as there is a competition from other MNCs. So the initial project cost, which was consisting of plant and machinery, including installation, is estimated to be $500 million. So the initial outflow would be $500 million. That will be for the plant and machinery. Apart from that, there would be a working capital requirement of $50 million. Now, the company is following a straight line method of depreciation, and presently the company is exporting 2 million units every year at a unit price of 80 million. Sorry, $80 per unit, with the variable cost being $40. So the Chief Financial Officer has estimated the following operating cost and other data in respect of the proposed project. So we are trying to calculate an alternative to set up a subsidiary, and the idea is to find out whether the subsidiary will be viable as compared to the existing scenario where we are just exporting. So the existing scenario is exporting 2 million at the rate of 80 USD, where the variable cost is 40 USD. Now, Chief Financial Officer has also estimated the operating cost if you are setting up the project. The variable cost is going to be reduced to $20 per unit, but there would be an additional fixed cost of $30 million per annum. So we will evaluate the project as on annual basis. The project share of allocated fixed cost will be $3 million per annum. This will be our irrelevant cost. Allocating already existing cost to share from a new subsidiary is irrelevant because no matter whether the subsidiary is set or not, the company will incur this fixed cost. Now, the production capacity would be 5 million. So earlier you were selling 2 million at 80. Now you would be able to sell 5 million at 80. Life of the project plant is 5 years with no salvage value. This helps us calculate the depreciation aspect. So depreciation would be 500 million with no salvage value spread over 5 years in straight line method. So the depreciation would be $100 million. Okay. Further, existing working capital requirement investment for production and sale of 2 million units through export was $15 million, which would now be automatically assumed to be released if we take up the subsidiary. Export of the product in the coming year will decrease to 1.5 million. So when you are going to compare whether to set up a subsidiary or whether to continue to export, we cannot continue with 2 million units which we were exporting because the change scenario is now you have to compare 1.5 million units which you will now be able to sell because the exports will decrease and if the company does not open the subsidiary in India. So there is no dearth of product demand. Product can be sold. So if you set up a subsidiary, it is 5 million. However, if you continue to export because of competition, your number of units would reduce from 2 million to 1.5 million. Therefore, comparison should not be between 5 million and 2 million. Comparison has to be as per the change scenario. If you set up subsidiary, you will be able to sell 5 million. But if you continue to export, it will be 1.5 million units. Corporate tax rates, 35%. and required rate of return from the project is 12%. So assuming there is no variation in the exchange rate of two currencies and all profits would be repatriated, there is no withholding tax. Estimate the NPV of the proposed project in India using the following present value interest factors at 12% for 5 years. Okay, so let us start. First, let's calculate what would be the initial cash outflow. So the initial cash outflow would be plant and machinery, which is of $500 million, working capital requirement, which is 50 million, okay, less release of working capital from export business. So because you are setting up a subsidiary, you will stop exporting and there would be a release of 15 million USD from the exporting business. So the $50 million which you are required for working capital, 15 will come from the existing and another 35 will be blocked. So your initial requirement would be 535 million. Okay. Second step, we'll calculate the operating cash inflows or outflows. So let's call it operating cash flows from subsidiary. So if you set up the subsidiary, you are able to sell how many millions? 5 million units. Price will assume to be remaining the same, $80. So 5 million units at the rate of 80 with a variable cost of 20, fixed cost of 30 million per annum, and 100 million would be the depreciation. Tax rate 35%. So let's calculate. So revenue would be 5 million into 5 million units multiplied by 80. 400 million USD. Less costs. So variable cost 5 million units at the rate of 20. So 100 million. Then you have fixed cost annually 30 million, as well as you will subtract the depreciation another 100 million. So out of 400, variable cost, fixed cost, and appreciation 230 goes, and you are left with 170 million. So let's just see. After this becomes your profits before tax. I'll continue it here. PBT is 170. Then less taxes. Taxes at the rate of 35%. So 170 million into 35%, you end up paying tax of 59.5 million, and you're left with 110.5 million. Profits after tax. Now we need to calculate cash flows after tax from subsidiary. So add non-cash item, which is depreciation, another $100 million. So the cash inflows from setting up the subsidiary for the next 5 years will be 210.5 million US dollars, right? Now let's compare cash flows from exporting. Have we continued to export? What would have been the cash inflows? So revenue would then have been 1.5 million units would have been sold into $80. $120 million less variable cost. Variable cost would have been 1.5 million units into $40 per unit. So earlier 2 million units were sold at $80 per unit with a variable cost of $40. We are selling now only 1.5 million units with selling price remaining the same and variable cost remaining the same. So 1.5 into 40, $60 million would go as variable cost. Anything else, any fixed cost, nothing, only the variable cost is being presented here. Taxes would still be paid. So your profits before tax, earnings before tax would be $60 million less tax at the rate of 35%. So $60 million into 0.35, you would end up paying 21 million as taxes, and therefore earnings after tax or cash flows after tax would be 39 million. So the incremental cash inflows from setting subsidiary from 1 to 5 years is 210.5. From subsidiary you have 210.5, and from exports you have 39 million. So 210.5 minus 39 million. So you will have incremental cash inflows of 171.5 for 5 years. Okay. So if you look at the PVIFA factors, 171.5 for 5 years. What is the PVIF factors? These are the PVIF factors. But if I multiply, because it's constant, if we create an annuity, 5 years, 12%. So I can add up all these factors and I'll get the PVIFA factor for 5 years. So it is 0.8929 plus 0.7972 plus 0.7118 plus 0.6355 plus 0.5674. So it is 3.6048, 171.5 multiplied by 3.6048. So the present value of operating cash inflows will be 618.2232. So present value of cash inflows from operations is 171.5 into 3 point factor, which was 618.2232. Further, let's calculate the last terminal cash inflows. So in terminal, we don't have any salvage value from the plant and machinery, neither it is giving us anything. However, the working capital which was blocked. So how much was the working capital block? Net, it was 35. 500 was the plant and machinery, and the working capital from export was released. So the total working capital that would be now released in the terminal year, in the fifth year, is $35 million. Working capital released, $35 million. And the present value of this is 35 multiplied by PVIF factor, fifth year, 12%. So 35 multiplied by 0.5674. This was the PVIF factor at 12% for the fifth year. 35 into 0.5674 makes it 119.859. Now you can evaluate whether the project is worth accepting or not. So present value of inflows is, total inflows is 618.2232 plus 19.859. Roughly you can call it 20. So 638.2232 if I round it off to 20, or you can take it exactly also. 618.2232. So it's 638.0822. And what was the initial outflow? 535. So the NPV of the project will come out to be, this will be your final table, present value of inflows minus present value of outflows, or initial outflow, because outflow is only at the 0 year. So you are net 103.082, or you can leave it to two decimals, 103.08 million US dollar is your NPV. Therefore, the project is worth accepting. So it's better for the company to set up a subsidiary in India rather than continue to export. Right? Is it clear? Any doubts? All right, then we can take up the next question here. XYZ Limited is a company based in India. Manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. So manufacturing is in India, high quality modern furniture, and retail outlets are there in India and Nepal. where this furniture is sold. It is facing tough competition, and recent studies on marketability of the products have clearly indicated customers are now more interested in variety and choice rather than exclusivity and exceptional quality. Since the cost of the quality wood in India is very high, the company is reviewing the proposal for import of woods in bulk from the Nepalese supplier. So we are going to import the wood from Nepalese supplier, and the estimate of the net Indian rupee and the Nepalese currency cash flows in nominal terms. So these are nominal for the proposal is shown below. Year 0, 1, 2, 3. So the project is for 3 years. Figures are in millions. How much would be the outflow in the Nepalese currency in 0 year? It's minus 25 or 25 million. In the first year, you will get an inflow of 2.6 million, 3.8 million, and 4.1 million. Correspondingly, in the Indian currency, 0 year outflow or inflow is zero. In the first year, second year, third year, these are the inflows. These are in terms of rupees, and this is in terms of Nepalese currency. Following information is relevant. XYZ Limited evaluates all investments by using a discount rate of 9% per annum. So we are calculating from the Indian perspective, the domestic currency will be using the investment will be discounted at 9%. Nepalese currencies, customers are invoiced in Nepalese currency only. Their cash flows will be converted to Indian rupee at the forward rate and then discounted at the Indian rate. So what we are supposed to do is to convert all the Nepalese currency inflows, outflows into the Indian rupee and then club it with the Indian corresponding inflow, outflow, which is also in rupee, and discount it at 9% per annum. Inflation rates in Nepal and India are expected to be 9%. So 9% is for Nepal, whereas for India it is 8%. And the current spot exchange rate is 1 rupee is equivalent to Nepalese currency 1.6. So Nepalese currency and rupee, the current exchange rate is 1.6. Now, first step would be to calculate the forward rates as mentioned here. Nepalese rupee inflow will be converted to Indian rupee using the forward rates. And as forward rates are not given here, we'll continue to use the interest rate parity. Assuming that it holds good. Assuming that you are the finance manager of XYZ, calculate the NPV and MIRR of the proposal, the modified IRR. You may use following values with respect to the discount factor of rupee 1 at 9%. So these are the present value factors and these are the future value. Okay, but these are not future value factors. This is the future value. Year 1 inflow will become, inflow or outflow, will become 1.188 at the end of third year. So whatever you receive after the end of first year will convert into 1.188 after the end of third year. Whatever you receive at the end of second year will get converted into 1.090 at the end of third year. So this will remain invested for 1 year. This amount remains invested for 2 years. And whatever you get at the end of third year will remain as it is at the end of third year. So 1 rupee will remain 1. Okay, these are not FEIF factors, but this is what it is mentioning, what will become the future value of the cash inflow you receive at the end of first year. What will be the value after 2 years? Firstly, let's calculate the this will become your working notes. First, calculation of forward rates. Of Nepalese currency against rupee. using interest rate parity here, covered interest parity or IRP. Inflation in India, 8%. Inflation in, sorry, was it inflation? Yeah, okay, 9 and 8%. So not interest rate parity, but purchasing power parity. Inflation in Nepal, 9%. So forward rates, year 1, year 2, year 3, this will become 1.6 multiplied by 1.09 upon 1.08. So whatever the figure comes here, you can use that, or this you can calculate as 1.6, 1.09 upon 1.08 square, and this is 1.6, 1.09, 1.08 cube. You might get a little small differences in your answers here, because if you use these factors and you round off, then you get a different answer. Whereas if you take 1.6 into 1.09 and divide by 1.08, so the first year's exchange rate will definitely be 1.6148. Now, if you are using 1.6148 and then using 1.09 square and 09 and 1.08, you will get a different answer. But if you get 1.6, so rounding off decimals may create a slight difference. No matter whatever you want to take, you can take that. So if I take 1.6148 and multiply again by 1.09, divide by 1.08. So it is 1.6297 or 98, if I round off to 4 decimals. And if I take 1.6298 and again multiply by 1.09, divide by 1.08, you end up getting 1.6449. So these are the forward rates you will use. Now, let's see what's the cash inflows or cash flows in Nepalese currency, year 0, 1, 2, 3. So in the first year, it was minus 25. All figures are in millions. And the exchange rate was also 1.6. Then you had, will not use the exchange rate here, 2.6, 3.8, and 4.1. 2.6 million, 3.8, and 4.1 million. You can convert the cash flows in Nepalese currency into cash flows in INR using the forward rate. So 1.6, 1.6148, 1.629, and 1.6449. So when we'll convert it into INR, 1 rupee is equivalent to 1.6. So 25 million will become 25 divided by 1.6, 15.625. So initial outflow in INR is 15.625. The second year inflow in Nepalese currency, 2.6 million. Converted into Indian currency, it is 1.610. 3.8 divided by 1.629, 2.332 or 3, and 4.1 divided by 1.6449. It is 2.493. Cash flow from the project. From Nepal, but in INR or Indian rupee. From India, and this is also in terms of rupee total. So from Nepal, we have the figure. It's minus 15.625, 1.610, 2.333, and 2.493. From Indian, 2.869, 4.2, and 4.6. Two 2.869, I guess. Yeah. All figures in millions. So the total cash inflows, outflows would be 15.625 from the project. Then you will add the two, 1.610 plus 2.869, 4.479, 2.333 plus 4.2, 6.533, and 2.493 plus 4.6. It's 7.093. Use the PVIF factors, which are given 0.917, 842, and 772. 0 year, it will be 1 only. So the present value factors are at 9%. Right? So it's minus 15.625 rupees million, 4.479 into 0.917. It's 4.107 to 6.533 multiplied by 0.842, 5.5007, and 7.093 multiplied by 0.772, 5.4758. NPV 4.1072 plus 5.5007 plus 5.4758. So inflows is 15.0837, whereas outflow is 15.625. So slightly negative. NPV is 0.5413 negative. So 0.5413 million Indian rupee loss, which is equivalent to 5,41,300. So NPV suggests this project will not be viable. However, there is one more thing which is required to be calculated, which is MIRR, the modified internal rate of return. I'm sure you would be aware what is MIRR because the internal rate of return has this limitation. There is a limitation that all the intermittent inflows are also reinvested at the same rate, which is the IRR, which is not possible practically. So we calculate a modified internal rate of return where the intermittent cash flows are reinvested at the given rate, which is practically possible. So here, the reinvestment rate is also given as 9%. So you had inflows in year one, year two, and year three, and your initial investment in year zero was also given. So in year one, what you have received is 4.479. In year two, it is 6.533. And in year three, 7.093. So cash flows of year one after 2 years or at the end of third year. This future value is given. So this 4.999, when it moves here, it becomes 4.479 multiplied by 1.18. Remember, the FVIF factor was given 1.188. Obviously, in 2 years, 9%, you will get 18% and a little more than that. Okay. So 4.479 multiplied by 1.188. This becomes 5.3210. The cash flow which you are getting at the end of year two, at the end of third year. So this figure will become, it will get 1 year's interest. So I simply multiply by 1.09 and the factor would also be 1.09. Give it one interest, 6.533 multiplied by 1.09. This becomes 7.12097. And initially you had 7.093. So total inflow will be 7.12097 plus 5.3210 plus 7.093. It's 19.5350 roughly after rounding off. 497 was the figure. I have rounded off to 50. Right? Now, how do we calculate IRR? It's the same formula that you use for compound interest. Amount is equal to principal 1 plus I or rate raised to the power n. So here the amount has become 19.5350. The principal that you invested was 15.625. All calculations are in Indian rupees, okay? And we are trying to calculate modified internal rate of return after the project for 3 years. So if we will solve this, 1 plus MIRR becomes 19.5350 divided by 15.625. So 1 plus MIRR becomes third root of this figure. So you will calculate the third root of third root of 1.25. So 1 plus MIRR is equivalent to 1.07728 or 773 roughly, or MIRR is equivalent to, in decimals, 0.0772. So the modified internal rate of return multiplied by 100, 7.72% roughly. Okay, so this is how you calculate. And now you can also see one more thing, that when you were discounting it at 9%, the project was not viable. The negative NPV was there. So it's very likely because the internal rate generated by this project is 7.728%. So it's not giving you 9%. Therefore, at 9%, your NPV turned out to be a little negative. Correct? Is it clear?
How can we calculate third root?
Okay. In quantitative aptitude, must have done in the foundation also. If you use your normal calculators, just when you will type 19.5350 divided by 15.625, you get a factor as 1.25. So there are certain steps, like when you have in your calculator 1.25 or type that, press the under root key 12 times, right? Minus 1, divide by 3 because you're taking the third root, plus 1, and then again multiply into and equal to keys 12 times. You will get the answer to normal calculator. But don't worry, when these kind of calculations are generally given in the examination, the factors are given for you. Okay. So most probably, maybe you get the third root of this as a figure. But to confuse, maybe third root of this and two or more three numbers would be given. So you will have to select which one you need. Okay.
Okay, thank
You
you.
can try out this trick. This works in a normal calculator. So instead of trying for 1.25, you know that the third root of 8 will be 2. So type 8, press under root 12 times, minus 1, divide by 3, plus 1, and then into equal to 12 times. Both. Just don't keep on pressing equal to, into equal to 12 times. You get an approximate answer. Okay?
Right, thank you.
Welcome. So, any question? Is this clear? So, what are we supposed to do in this question? You are given inflows in Nepalese currency as well as in Indian currency. All calculations are to be done in Indian currency and discount rate is 9% for India. So convert the Nepalese currency's cash flows into Indian currency using the forward rates. Forward rates will be calculated by you using the inflation rates and purchasing power parity theorem. Once you have done that, club the Indian cash flows and the Nepalese cash flows. Now you have cash flows and the PVIF factors, and you can calculate the NPV. However, the question is also demanding you to calculate the MIRR. So reinvestment rate is also assumed at 9%. So whatever you get after second year will remain invested for 1 year. So 1 rupee will become 1.09. Whatever you get at the end of first year will remain invested for 2 years till you are reach the end of third year. So you will get two interests there. So 1.09 square or 1.188. Okay. That gives you the MIRR. So your terminally, you will be ending up having 19.5350. with your inflows of the 3 year, and initially you invested 15.625. So MIRR will be 7.728%. If you have any questions, you can ask. Otherwise, I'll proceed further. Shall I? Leela, Sanjay, everyone. All right, let's move on to the next question. DK Limited is considering an investment proposal in Sri Lanka involving an initial investment of Sri Lankan rupee 25 billion. So you are talking about an investment proposal in Sri Lanka, and investment would be 25 billion. The current spot rate exchange rate is 1 INR is equal to 0.37 Sri Lankan rupee. Indian rupee and Lankan rupee, the exchange rate is 0.37. Indian rupee is at premium, it's more strong. So in 1 Indian rupee, you will be giving you the Sri Lankan rupee, you can get 0.37. The risk-free rate in India is 6%, and the same in Sri Lanka is 5.20%. These are the interest rates. Project will generate a cash flow of Lankan rupee 5 billion in the first year, and this is likely to increase by 1 billion each year for the next 4 years. So the project has a life of 5 years so far. Project will wind up in completion of 5 years with no salvage value. So that's it. There is no perpetuity. The project is going to be terminated at the end of 5th year, and there is no salvage value from your investments. So that helps us in calculation for depreciation, 25 billion minus 0 over 5 years if it is straight line. The required rate of the project is 8%, and you're required to find out the investment worth of the project by using home currency approach and using the foreign currency approach. Compare the outcome under the both approaches. The PVIF factors at 8% and PVIF factors at 7% are also given. Now, if you remember, we have done an earlier question in US dollar where we were supposed to calculate the project's viability using the foreign currency approach. So when we use the foreign currency approach, our first step was to find out the risk premium or the rate of interest at which we will be discounting. Now the rate of interest was calculated applying the risk premium. Okay, so I'm creating the first working note here. The rate of discount applicable if foreign currency approach is used. So for that, first the risk-free in India, 6%, and in Sri Lanka, the risk-free is 5.2%. In India, we are discounting at the rate of 8%. The required rate of return for the project is 8%. So DK Limited is Indian and its required rate of return is 8%. So why 2% extra? Because there is some risk associated with the project, and that we will calculate. And that same figure, whatever we get here, will automatically apply here, and we'll calculate the discount rate applicable in the Sri Lankan currency if we do the calculations. Okay. So if you remember, it was 1 plus risk-free multiplied by 1 plus risk premium should give you the 1 plus discount rate. So it's 1.06 multiplied by 1 plus risk-free, which we are trying to find. but we know that the discount rate in India is 1.08. So this gives you the risk premium. 1 plus risk premium will be 1.08 divided by 1.06, which is equal to 1.0188 or 89 you can take because it is 67. So the discount rate applicable for Sri Lanka would be 1.052 risk free multiplied by the risk premium of 1.0188 or 89. So it comes out to be 1.0718. So roughly 7.2%, but we can take the 7% as given in the question and you can write a note for that. So if you try to calculate the NPV in home currency, you will use the discount rate at 8%. But if you try to calculate the present value in foreign currency approach, the discount rate applicable should be 7.18%, roughly 7%. So we'll discount it at 7%. Okay. So this is your first working note to calculate what discount rate you will use. Now let's see what is the scenario, and you'll also require to calculate the forward rates using the purchase interest rate parity this time, using risk-free rate of interest. So first step, calculate the so INR to Lankan rupee is 0.37. So the Sri Lankan currency is at the Indian currency is strong here. And what is the current rate and what is the risk-free rates? 6% and 5.2%. Okay. So if I say here that in one rupee, actually you can get 1 divided by 0.37. It is written like this, no? INR upon. So in 1 rupee, 1 divided by 0.37. You end up getting 2.70. Now, if you're using the purchasing power parity, the interest rate parity or purchasing power parity, we know that whatever the currency is in the numerator, that rate of interest would be applied earlier. So here you have INR uh, more, so 0.37 and into 1.06 divided by 1.052. So 0.3728. Okay. So first you will calculate the rate of exchange for Indian rupee against the Sri Lankan rupee. The rate given is it a direct quote or an indirect quote? Is it a direct quote for India or an indirect quote?
Indirect.
INR is numerator and Sri Lankan currency is 1. 1 Lankan currency will give you 0.37 Indian rupee. So direct or indirect? It's a direct quote for India. 1 Lankan currency is given, no? 1 Sri Lankan currency will give you how many rupees? 0.37. Indian rupee is more stronger, right? Rupee by dollar, how much was it? $1, 88. So which currency is stronger? Dollar is stronger, 88 something. Rupee is weak, that's why it is more than 1. Here, the Indian rupee is stronger. So 1 Sri Lankan currency will fetch you only 0.37 Indian rupee. Okay. So it's a direct quote, rupee by LKR. And therefore, 0.37. First, you'll use where is the inflation higher or interest is higher in India, 6%, whereas in Sri Lanka it is 5.20%. So if interest rate parity holds good, it will be 0.37 into 1.06 upon 1.052. If I had used this one, I would have multiplied by 1.052 upon 1.06, but that would have become an indirect quote. So I'll go by the direct quote 0.37 and apply this. Next year, 0.3728 multiplied by 1.06 upon 1.052. So similarly, you will be able to calculate the direct quotes, the forward rates for all the 5 years. 0.3728 multiplied by 1.06 and divide by 1.052. So it's 0.3756. Next year, 0.3756 again multiplied by 1.06 and 1.052. It's 0.3785, 0.3785 multiplied by 1.06 and 1.052. It's 0.3814 and 0.3814 multiplied by 1.06 and divided by 1.052. Comes out to be 0.3843. Now, these rates will be applicable when you are doing the evaluation in home currency. But if you are doing the evaluation in foreign currency, so let's do it first in foreign currency. LKR, all figures are in billions. So 0-year investment is 25 billion and cash flows are straight away given. So we don't need to calculate the depreciation. We assume the cash flows and we'll accept them as it is, starting from 5 billion, increasing 1 billion every year for the next 4 years. So it's year 0, 1, 2, 3, 4, 5, cash flows minus 25 4, 5 billion, 6 billion, 7 billion, 8 billion, and 9 billion. Right? Initial investment 25 billion. Risk-free rate 6% and 5.2 that we have worked out. Cash inflows 5 billion for the first year will increase by 1 billion every year for the next 4 years. After 5 years, the project will be complete with no salvage value. And required rate of return is 8%. But if you're evaluating in foreign currency, the discount rate used would be 7%. And using these factors, I'm sure you'll be able to calculate these are given till 5 decimals. So now specifically if the question is giving you the PVIF factors, you are going to use that only. You're not going to round off till 3 decimals or 4 decimals. If they're given till 5 decimals, you're going to use as it is. So the PVIF factors at 7%. Why you are taking 7%? This will be the working note 1. So 1, 0. 0.93457, 87344, 81630, 76290, and 71299. So I'm sure you will be able to evaluate the NPV in terms of foreign currency, and whatever it comes out, you can convert it using the current spot exchange rate. So this will be multiplied by 0.37, okay, to find out the answer in Indian rupee. Let's see. Let's do it quickly, okay? It's minus 25 because we are also required to uh, compare the two results. Seven multiplied by 0.81630, 5.7141, 8 multiplied by 0.76290, it's 6.1032, and 9 multiplied by 0.71299, it's 6.41691. When you add the inflows, inflows are 28.1477 minus 25 billion outflow. So inflows are 3.1477 billion Sri Lankan rupee multiplied by 0.37. So in Indian rupee, the inflow is 1.1646 billion INR. So the project is giving you a positive inflow of 1.1646. Now, if the same is to be evaluated in terms of the home currency, Indian rupee, so we'll convert all these cash flows into Indian rupee using the forward rates. Okay. Cash flows 25 billion in LKR. 5, 6, 7, 8, 9. Cash flows converted into INR. Once again in billions. So 25 into 0.37 is equivalent to only 9.25 billion. Then using these rates, 3728, 5 into 0.3728, it's 1.864 billion. 6 into 3756, 2.2536, 7 into 0.3785, 2.6495, 3814, 8 into 0.3814, 3.0512, and finally 3843. 9 into 0.3843, it's 3.4587. PVIF factors at 8% this time. So it's minus 9.2 present values. Straight away, I'll calculate the present values using PVIF factors at 8%. So it's minus 9.25 for the 0 year. Then 1.864 will be multiplied by 0.92593. 1.864. So you get plus 1.7259. The second factor is 0.85734. That will be multiplied by 2.2536. 1.9321. Third year's factor is 0.79383. This will be multiplied by 2.6495. It's 2.1033. Then 0.73503. Into 3.0512, 2.2427, and finally last 0.68058. 0.68058 multiplied by 3.4587. So 2.3539. Now if you will calculate 1.7259 plus 1.9321 plus 2.1033 plus 2.2427 and finally 2.3539. So the present value of inflows is 10.3579 minus 9.25. It's 1.1079. So when you compare the results, if you evaluate in the current home currency, the present value of inflows is rupees 1.1079 billion. Whereas if you had calculated it in the Sri Lankan currency, it was 1.1646. So the NPV is more positive when you're calculating in foreign currency rather than in Indian currency. Reason being, we have seen that the rate of interest was higher in India as compared to the Sri Lankan currency. Therefore, the inflow, when you convert it into home currency, the NPV is a little less than the foreign currency calculation. So rupee was, the Lankan currency was gaining. It was strengthening against rupee. Therefore, the inflows or the present value in home currency is less. Okay. Any doubts? Any doubts? So what are we about to do here? Calculate the NPV using foreign currency and home currency approach. Okay. Let us now look at another important question. There is a US company. It wants to set up a manufacturing plant in India, which requires an initial outflow of 8 million rupees. Life 5 years. Salvage value of the plant 2 million. Company follows straight line method of depreciation. To support additional level of activity, investment would also require a one-time additional working capital of 1 million. So roughly you have calculated that your initial cash outflows will be 8 plus 1, 9 million rupees, and in the terminal year, 2 million of the salvage value plus 1 million working capital. So you will end up getting 3 million in the terminal year. So as you read the question, a little working should start there and then. Okay. Another important thing, we are already aware that the cost of the project is 8 million and with a salvage value of 2 million and straight line method of depreciation. So simple calculation for depreciation would also be, you can do it here also, that 8 million minus 2 million, that is 6 million would be depreciated over 5 years. So the depreciation would be 1.2 million. Okay. Another important thing here is because the salvage value is also 2 and the book value will also be 2, there would be no tax implication on the salvage value. Whatever you have the salvage value, you'll get it. Now the cost of production is lower in India. So the variable cost of production would be 30 rupee per unit. There would be additional fixed cost per annum, which is estimated to be rupee 0.5 million. So another 5 lakh will go as fixed cost and the per unit cost would be 30 rupee per unit, variable cost. So two elements of cost are there, 30 rupee per unit, the variable cost and fixed cost of 0.5 million. Company is projecting annual sales to be 80,000 units. Volume is 80,000 units. Selling price, revenue will be 80,000 into 100. Tax rate applicable, another important term, 34%. And cost of capital discount rate is 8%. Inflation rates in US and India are expected to be 8 and 9%. So it's 9% in India, Indian currency will depreciate as the rate of interest is higher in India. Current rate is 72 rupee per dollar. Assuming that all profits will be repatriated every year, no withholding taxes, estimate the NPV of the project in India and evaluate its feasibility. PVF of 8% for the 5 years. So 8% is the rate of interest applicable in US. And the present value factors are also given at 8% for the 5 years. So we are going to calculate whatever the outflows are there in India. We'll convert it into US dollar, as it's saying all profits will be repatriated. Convert it into US dollar and then discount them at the rate applicable in US, which is 8%. Okay, so let's do the calculations here. Your working notes. First, initial outflow. Project cost in rupees in million. Working capital 1 million. 8 million initial outlay and working capital 1 million. So initial outflow would be rupees 9 million. Okay, I'll start here. Second working note, cash from operations from 1 to 5 years. Revenue would be 80,000 units sold at 100 rupee per unit. Rupees in million. So it's 8 million. Cost, one is variable cost, which is 80,000 into 20, I guess, 30. 2.4 million. Fixed costs are given per annum 0.5 million. And we have also calculated the depreciation. You can calculate a working note for the depreciation 1.2 million. Original cost minus salvage value divided by number of years as per straight line method. So the total cost would be 4.1 million. Your profits before tax 3.9 million. Taxes at the rate of 34%. You end up paying 1.326 as corporate tax. There is no withholding tax. Even if it was there, we could have assumed that if withholding tax is 10%, an additional 24% would be payable as taxes by the company. So the total would be 34% only. You can adjust the withholding taxes just like you adjust the TDS in India. So profits after tax 2.574. Add depreciation back 1.2 million, and you have the cash flows after tax for 5 years 3.774 million Indian rupees. Okay, so Initial cash flows and operating cash flows have been worked out. We also create a third column for terminal cash flows. It will be salvage value of the plant, which is 2 million. Once again, rupee in millions, plus release of working capital, 1 million. Even if the question is silent, it is always assumed that the entire working capital will be released towards the end of the project. So we have these figures: 3.774 million for 5 years, 9 million in the initial year, and 3 million rupees in the terminal year. The first is an outflow, and from 1 to 5, and fifth year is a inflow. Next, we need to calculate using the PVIF factors at 8%, and we need to calculate in terms of US currency. The current exchange rate is given as 72, with interest rates in India 9% and inflation in India 9% and in US 8%. So we need to convert these inflows of rupees into US currency, but for that, calculation of forward rates using purchasing power parity or purchasing power theorem. Here, 0, 1, 2, 3, 4, 5. Spot is 72, and 72 into 1.09 divided by 1.08. So these are the calculations you will be doing. I have given you both alternatives how you can calculate the forward rates. Either you can square and cube and raise to the power 4, or you can use the previous one, just like a bootstrapping concept. And from the previous forward rate, you can calculate the next. Same results, slight difference just because of rounding off of decimals. So 72 was the current exchange rate, inflation in US 8%, and inflation in India 9%. So your forward rate comes out to be 72 into 1.09 divided by 1.08. So 72.67. You can round it off to 2 decimals. You can write that. 73.34. .02 rather. 74.70 and 74.40. Sorry, 75.40. So cash flows in INR in millions converted into US currency. 9 million, 3.774 million, which will remain constant. You can extend the existing table itself. You can use this one only. And here you can say 3.774 plus another terminal 3-year inflow, 3 million inflow because of salvage value and the working capital. So use this forward rates 9 into 0, that's minus 9. Do the calculations. Uh, then divide by 72 and the initial outflow is 125,000 US dollars. 3.774 divide by 72.67. So it's 51,933. 3.774 divided by 73.34. 51,459. So you will continue to divide by the exchange rate of rupee by dollar and can convert it into dollars. $3.774 divided by 74.02 gives you 50,986. 3.774 divided by 74.70, 50,522. And 6.774. Either you can combine it or you can keep it separate, fifth year, and write 5 twice for the terminal value. Divide by 75.50, 89,722. So this is a minus, rest all are plus. Calculate the present value of the project in US currency. $50522 plus 89,722. These are your inflows. So the present value of inflows comes out to be quite positive here. 294,622 and minus 125,000. So the NPV is positive 169,622. Therefore, the project is, and this is in million dollars. Sorry, dollars, not million. Okay. So it is worth accepting the project. The project will be fruitful if the investment is made in US by the US company in India. So if you evaluate the feasibility, the project is feasible. So what have we done in this question? We have found the initial cash flows. We have found the operating cash flows using the revenue and cost and adding the depreciation back. And we have found the terminal cash flow. All this is converted into US dollar using the forward rates, which we calculated using purchasing power parity and evaluating the NPV, which is a positive number. So the project is quite feasible. Okay. All right, team, we can go for a short break of 10 minutes and then we'll join back. Right? Any questions? No? Okay. So let's give it a 10 minutes break here and come back again. Right. aspect was missing here. We have calculated the cash flows in terms of US currency, right? But we didn't apply the discount rate. So this is not NPV. NPV will be calculated further using these US currency inflows. So these are cash flows in dollars, not present value. Okay. So this will one more step, present value of or NPV of project at 8% discount rate. So whatever the cash flows you have calculated in the previous figure, you will write it here. 1, 2, 0, 1, 2, 3, 4, and 5. So it's minus 125, 51,933, 51459, 50986, 50522, and 8972. PVIF factors at 8%. So it's 0.926, 0.857, 0.794, 0.735, and 0.681. This will give you whether the project is feasible or not. So that calculation was just to convert the uh, cash flows into US currency. That was not calculating the present value of those inflows. 48,089 or 090 roughly. 51459 multiplied by 0.857. 44,100. 50986 multiplied by 0.794. 40,483. 50,522 multiplied by 0.735. 37,134. And finally, 89,722 multiplied by 0.681. So this is 61,101. Now you will get the NPV. 4809. Still, it will be positive because the earlier figure was quite significantly higher. 40483 plus 37134 and plus 61101. So the present value of inflows is 2,30,000 still, minus 1,25,000. Still end up getting NPV of 105,900. 0.08. So the project is still viable or the project is feasible as the NPV is positive. Okay. By this step, we have only calculated the cash flows in US dollars. Okay. Cannot calculate the NPV. This is not NPV, did not use the PVIF factors here, just the forward rates to convert the cash flows into from INR to US dollars. Then you will apply one more step, the PVIF. So you can continue in this table itself. Okay. Right. So this was your question 9, where the company is setting up the project in US. US company is setting up a investment in India in rupees, and then whatever the money profits it gets, it will repatriate that every year. Okay. Uh, let's look at this question. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. Entire production will be exported at a selling price of USD 10 per unit. Current rate of exchange dollar of local production equals to US dollar 6 per unit, and dollar is expected to decline by 10% or 15%. So here we are expecting the dollar to weaken against rupee. It can go either by 10% or by 15%, but it's not sure how much. And the change in local cost of production and probability from the expected current level will be as follows. So what it is saying is that you're going to produce with an annual output of 1 million units. This, whatever production is, will be sold to the US at $10 per unit. However, the cost of production is $6 per unit, but the dollar can decline against rupee, which can decline either, it is expected. So it may not decline, it may decline by 10%, it may also decline by 15%. The change will happen if the dollar declines. The local cost of production and will also change, as well as the probability of this happening is also given. So decline in the value of US dollar can be 0%, 10%, 15%. If this happens, the local cost of production, US dollar per unit, which is 6 already, can become reduced by 0.30. Just a minute, team. So dollar is expected to decline by 10% or 15%. These are the three scenarios, 0.4, 0.4, and 0.2. The plant at the current rate of exchange will have a depreciation of US dollar 1 million annually, and assuming the local tax rate at 30%. You require to find out the annual cash flows under all the different scenarios of exchange rate, expected value of cash flows after tax, assuming no repatriation of profits, and viability of the investment proposal, assuming initial investment of $25 million on plant and working capital with the required rate of return of 11% on investment, and on the basis of CFAT, which you arrive at under option 2. So the expected CFAT that will be used. The CFAT is expected to grow at 3% per annum in perpetuity. Okay. So I hope you've understood the question here. What it is saying is, firstly, there are three possible scenarios, 1, 2, and 3. Under these three possible scenarios, with the probability of 0.4, 0.4, 0.2, the exchange rate of dollar may remain same. It may decline by 10% or it may decline by 15%. In case it remains same, the cost of production will remain 6 per unit. But if it declines by 10%, the cost of production will also reduce by 0.30. And if it reduces by 15%, declines by 15%, the cost of production will further get reduced by another $0.15 per unit. The selling price is $10 per unit, and 1 million units will be sold. So annual output is given, selling price is given, cost of production under three different scenarios would be different. Plus, there would be one more thing, the depreciation. So the depreciation is 1 million annually, assuming the current exchange rate. So depreciation will remain constant at $1 million, $1 million, $1 million if the rate of exchange remains same, because depreciation is applied on the cost of asset which is purchased at 0 year. However, if the rate of exchange changes, the depreciation will also be getting reduced or declining by 10% here and by 15% here. So it's not specific like 0.30 reduction or an additional 0.15 reduction. It's simply the 1 million will get reduced by 10% and 15%. Tax rates are 30%. Okay. So first we have to calculate the annual cash flows after tax under all the different scenarios of exchange rate. So let's create the solution here. Let's take the three scenarios. Scenario 1, Scenario 2, and Scenario 3. So what would be the revenue? Revenue would be 1 million units into $10. So revenue will be 10 million. But the cost of production will change. So number of units will remain 1 million throughout. Number of the selling price will remain 10 throughout. So the US dollar production revenue will be 10 million, 10 million, and 10 million. Cost of production here would be 1 million units into $6. So it would be 6 million. However, the cost of production will reduce. It's the local cost of production which will be impacted. The revenue will not be impacted. It will remain USD 10. But the cost of production will get impacted because it is local cost of production. So if dollar declines, it will not be $6, it will be 5.7. $1 million into 5.7. And it is saying further, in case there is a 15% reduction. So here it is no decline. Here it is 10% decline. And here it is 15% decline in currency. The probability is 0.40, 0.40, and 0.20. So 5.7 will get further reduced by 0.15. So it will be 5.55. This is the local cost of production. There will be additional cost of depreciation. The depreciation is expected to be 1 million annually with the current exchange rate, which will get declined by 10%. So it will be 99 lakhs. Okay. And here it will be or 0.9 million. And here it declines by 15%. So it will be 0.85 million, we can say, or 8,50,000. So your profits before tax will be calculated here. 10 million minus 7, it is 3 million. 10 minus 6.6, 3.4 million. And 10 minus 5.55 and plus 0.85. Total cost is 6.4 and 10 minus 6.4, 3.6. You end up giving tax on this. Tax rates are 30%. Zero 0.90, 1.02, and 1.08. So profits after tax 2.10, 2.38, 2.38, and 3.6 minus 1.08, 2.52. So these are the profits after tax under the three scenarios. To calculate CFAT, add back depreciation. 1.0, 0.90, and 0.85. So cash flows after tax 3.10, 3.28 million, and 2.52 plus 0.85, 3.37. So these are the three possible scenarios of the cash flows. It can be 3.10, 3.28, or 3.37. So solution to the first part is done, which is asking you annual cash flows after tax under all the different scenarios of exchange rate. Okay. Then expected value of CFAT, assuming no repatriation of profits. So what will be the expected value of CFAT? Like we have said, summation XIPI is how you calculate the expected value. So the cash flows under the three scenarios are 1, 2, and 3. Cash flows are 3.1, 3.28, and 3.37. Probabilities associated with the three scenario 0.40, 0.40, and 0.20. This is P. XIPI 3.10 into 0.4, 1.24, 3.28 into 0.4, 1.312, and 3.37 into 0.2. This is 0.674. Summation or the expected cash flows. $1.24 plus 1.312 plus 0.674. So you can expect the cash flows to be 3.226. Okay. 3.226 is the expected cash flow. This is in USD and in millions, right? So what are we supposed to do here in this question? The units will remain same. The selling price will remain same as $10 per unit. However, the cost will reduce from 6 to 5.7 or 5.55 under the three scenarios. And depreciation, which was 1 million, will also reduce to 99 lakhs or 8.5 lakhs if there is a reduction or decline in the exchange rate by 10% or 15%. So the calculation of depreciation will also get reduced. So you'll calculate the cash flows after tax under all the three scenarios using 30% tax rate and multiply by the respective probabilities to find out the expected value of cash flow from the project. First part is done, three scenarios. Second part is done, 3.322, whatever it is. Let's calculate the third part. Viability is asked of the investment proposal, assuming that there's an initial investment of 25 million on the plant and there's a working capital requirement. Required rate of return is 11%. Plant and working capital. So together, the total initial investment is 25 million. The required rate of return is 11%. And whatever the CFAT you have arrived at earlier. So what CFAT did we arrive at? 3.226. Expected value of the cash inflows, $3.226 million. So on investment, on the basis of the CFAT arrived at under option 2, the CFAT is likely to grow for 3% till perpetuity. So this is the same concept as finding the present value of all future cash flows. Assuming that they will grow at 3%. So the same formula that we've been using for earning dividend price model, that the price of the share is given by D1 upon KE minus G. Okay, this is not to be written as a solution. This is just for your reference. Same concept will be used. So cash flows, this is after 1 year and discounted by whatever the required return, K is 11% and growth is 3%. So this will give you the present value of all future cash flows. So the current cash flow is how much? 3.226. This will also grow at 3%. So this becomes D1 or the cash flows after the next period divided by 0.11 minus 0.03. So this will be the present value of all future cash flows generated by the project. 3.226 into 1.03 divided by 0.08, I can say, okay. 11 minus 3 is 8, so 0.08%, 0.8% or 0.08. So the present value of cash flows, considering these factors, is 41.53475. And what is the initial investment? 25 million. So we are checking the viability of the investment proposal. We'll say the investment is viable because the present value of these cash flows, which are expected, which will grow at 3% till perpetuity, discounted at 11% with a growth rate of 3%, gives the present value of 41.53475 million US dollars. and which is more than 25 million of the initial investment. Therefore, the project has a positive NPV and it is worth accepting. Okay, the project is significantly viable, no problem. Right? Is it clear? Yes or no?
Why isn't this revenue being affected by the exchange rate? I could not get it. The revenue
Why
remains
is,
10.
can you be, can you come
The
again?
revenue
Little
is
more clear?
remaining 10. Why isn't it affected by the exchange rate fluctuation, the decline in
Okay,
exchange rate?
okay. Why not? Foreign investment, creating a plant, output will not be affected by the exchange rate.
Yes,
Entire production will be exported.
yes,
Selling price is fixed.
yes.
So 1 million into 10
10 million.
dollars, $10 per unit. The export price is set at $10 per unit.
Right.
Okay. So someone is in US. He's setting up a plant here in India. Machine is in India. Production is in India. Okay. So what was happening? Let's say the production cost, variable cost was 100, or let's say it was 880. Hmm. Let's say it was 880 variable cost of production. So if the variable cost of production was 880 and currently assuming $88 rupee per dollar, we said that the variable cost was 10. We converted into USD. Okay, right?
Yes,
Now the exchange rate of dollar has declined. It has gone from 88 to let's say 44. Okay, dollar is expected to decline by 10% or 15%, and reduction in dollar will cause a reduction in local cost of production at USD per unit. So this is not, we don't need to calculate how much it will impact by the exchange rate or anything. But if you look at the reduction in the local cost of production, how much will it will be impacted by zero point 0.3. So this $10 will now become 9.7. This is given in the question. Okay,
yes,
right? So the variable cost, which was whatever $6, it has declined by 0.30. The exchange dollar cost of local production is equivalent to $6 per unit. And if the dollar declines, the local cost of production is said to be reduced by 0.30. So technically, what will happen is, if it was 6 earlier, 6 minus 0.3, it will become 5.7. But these figures are calculated in dollars only, 10 into 1. These are converted into dollars. Okay. If I set the export price as 20 euros, so even if euro is for 1 rupee or euro is for 100 rupee or even if euro is for 200 rupees, I'm going to get 1 euro only.
yes,
But if in India I was manufacturing this for 200 rupees and if the euro is 100, I was saying it is costing me 2 euros. But if euro becomes 200, it will start costing me 1 euro. Is it clear?
yes,
Alex. So the export is already set in US dollars. So this will not fluctuate. However, the local cost of production and the local depreciation calculation, this will get impacted because we are technically buying the machine in India. So the depreciation was, let's say, 100,000 rupees. But if you convert it into US dollar, at one time it becomes 1 million, at one time it will become something else with the change in exchange rate. Okay. So it's like translating the currency. So whatever the production you are doing, the production is translated into dollars, but the revenue is already in dollars. It's not converted.
Okay.
Right?
Right.
That's the reason. So is all the three aspects are clear?
Yes, clear.
Okay. So we'll move on to the next question. Question 11. Just read it. This uh, question has some concepts, so we will discuss this. First, let's read this. What does it say? The management of a multinational company, TL Limited, is engaged in construction of infrastructure project. Proposal to construct a toll road in Nepal is under consideration of the management. Following information is available. Investment is 250 lakhs USD. Life is 10 years. Depreciation, straight line. And earnings before interest, depreciation, tax, and amortizations. EBITDA is to be collected from the toll road. This is projected at 33 lakhs, USD 33 lakhs per annum for 20 years. So from whatever the information we have gathered, there is the toll road which is constructed in Nepal. However, the revenue is coming in USD. Okay. So what do we make out of this? Just a minute. So, so the initial investment is 250 lakhs. Revenue that is you are getting is EBITDA, which is 33 lakhs USD. This you will keep on getting for 20 years. But the life of the equipment is 10 years. It's not for 20 years. So depreciation will be claimed only for 10 years. And the method of charging depreciation is also straight line. We don't see anything related to salvage value of the equipment. So therefore, we assume it to be zero. So we'll have one working note which will do the calculation for depreciation. $250 minus zero over 10 lakh, 10 years. So it will be 25 lakhs USD. Okay. But this will only be for 10 years. However, your IDTA is 33 lakhs for 20 years. So there is slight anomaly here. You'll have to segregate the two periods. When you are charging depreciation, you have to calculate the present value after adding the depreciation back. But from 11th to 20th year, there will be no depreciation. Only 33 lakhs is what you will get. Now, to encourage the investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at an interest rate of 6% per annum. Interest is to be paid annually. Loan will be repaid at the end of 15 years in one tranche. So only interest is to be paid for 15 years, and towards the end you will end paying the repayment of the loan, 150 lakhs. Further, the required rate of return for a project under the all equity financing is 12%. So all equity means unlevered or ungeared. Then if it is a project which is financed solely through equity, then the required rate of return is 12%. Generally, the post-tax cost of debt is 5.6%. So it's the Nepalese government which is giving us 6% to induce us to invest. However, the post-tax cost of debt is 5.6% and corporate rate is 30%. All cash flows are to be done in USD. Okay, so that's it. That becomes irrelevant when there is no foreign exchange rate given, there's no fluctuation in the foreign exchange, there's no inflation or interest rates given for the two currencies. So let's do the complete calculations in USD only, which will become as easy as if you're doing in rupee. It will not make any impact. But you are required to advise the management on the viability of the project using adjusted NPV method. Now, what is adjusted NPV method is we calculate the feasibility of a project and we try to find out what is the certainty related to each project, each cash flow. So different cash flows have different level of certainties. For example, the debt is to be repaid. Okay, that will be certain how much interest you are paying. But the operating cash flows that may be uncertain. So you use different discounting rates for the different types of cash flows. You use a different discount rate for the operating cash flows. You use a different discount rate for the uh, interest paid on tax on the debt. You use a different discount rate, maybe for the subsidies which are received from the government, etc. So that is the adjusted present value method. So some factors are given here. PVIFA for 12% at 10 years, PVIFA 12% 20 years, PVIFA 8% 15 years, and PVIFA and PVIF 8% 15 years. Why 8%? Because the cost of debt is 5.6 per annum post tax. Tax rate is 30%. So that means 5.6 is 70% of the total cost of debt. So if 70% of KD cost of debt before tax is 5.6 after tax. So cost of debt becomes KD 5.6 divided by 70%. So it is 8%. Okay. So some important aspects here, we'll be using adjusted present value method. Okay. And in adjusted present value method, we will use different discount rates for the different parts of the cash flows. Sorry, team. All right. So let's understand what the question is. Management is constructing in Nepal. Initial outflow 250. Scrap salvage value 0. Life 10 years. So 25 lakh USD will be the depreciation for 10 years. EBITDA 33 lakhs for 20 years. And a term loan is available of 150 USD at 6%. However, the true cost of debt is 8%. The unlevered project is required rate of return from that is 12%, and corporate tax rate is 30%. All cash flows in USD, ignore inflation, and calculate using adjusted present value method. So first thing is, let's find out the cash flows from year 1 to year 10 when you have depreciation. So EB, earnings before depreciation, interest, tax, and amortizations, is 33 lakhs. Charge depreciation, which is 25 lakhs. We will not charge interest here because we are evaluating project cash flows. We are evaluating project, all equity project, and we will use 12%. So 8 lakhs is USD is the uh, profits before tax. If there is all equity minus tax at the rate of 30%. So profits after tax for the project is 5.6 and add depreciation 25. So CF80 from year 1 to 10 will be 30.6, right? Agree? 33 minus 25, 5.6 and add back the depreciation, 30.6. However, from year 10, 11 to 20, 33, depreciation nil, 33 would be the PBT, tax 33 into 0.3, 9.9, 23.1, no depreciation is to be added, so it will remain 23.1. Okay, clear? Now, very important fact here, PVIFA for it is constant, so you can use 5.650 as the present value interest factor. So for the first year, PVIFA is 5.650. Whereas from PVIFA from 11 to 20 years. Now see, what is the PVIFA? How do we calculate the PVIFA? These are all annuities, right? So let's say this is from 1 to 10 years. And then another from 11 to 20 years. So if I use the PVIFA from 10 years, okay, this brings all these payments to the 0 year. Whereas if I use the 20-year factor, this brings all these payments to 0 year. So if from the 20 years factor, I will subtract the PVIFA of 10 years, what I will be left with? The PVIFA applicable for this period. So from 11 to 20 years, if you want to find out the PVIFA, it is 7 point PVIFA for 20 years minus PVIFA factor for 10 years will give me the PVIFA factor for 11 to 20 years. So this implies 7.469 minus 5.650. Okay.
Ma'am, your voice is not listening.
Team, can you hear me now?
Yeah, ma'am. Now
All
I
right. I'm so sorry. All right. So I'll repeat. The management of a company, TL Limited, is engaged in construction of infrastructure project. Proposal to construct a toll road in Nepal is under construction. Okay. Did you hear the basic concept still there? At what point did you hear the question? Team, can you hear me?
We were calculating PVIFA from
Okay.
year 11 to
Okay.
20.
Okay. Great. So this is what I was saying. The important point in this question is that your EBITDA is 33 lakhs per annum. Now that is for 20 years, but the depreciation is available only for 10 years. So your cash flows would be different for 1 to 10 year, and it would be different in 11 to 20 years. So from 1 to 10 year, you will get the benefit of depreciation. So what was the earnings before depreciation and interest, tax and amortization? 33. You will deduct the depreciation. Profits before tax would be 8. On that, you will charge 30% tax, which is 2.4. Your profits after tax would be 5.6 million USD. And when you add depreciation back to this, your cash flows from year 1 to 10 is 30.6. However, as there is no depreciation benefit, tax benefit on depreciation, the cash flows in 11 to 20th year will be significantly lower. It will just be 23.1. So you'll end up paying higher tax on 33. You'll not get the depreciation expense. Now we need to calculate the present value of this 30.6 from year 1 to 10 and the present value of 23.1, which is from 11 to 20 years. So I was trying to explain to you, how do you calculate the present value from 11 to 20 years? Let me keep it simple. So if I have a 4-year period, right? Let's say the present value of 1 rupee at 10% for 4 years is this. These are the factors, right? So what happens if you calculate the PVIFA for 4 years, 10%? You add up all these four figures, right? So let us say the PVIFA for 4 years is 3 point something, 2.8 plus 3.4 something, let's say. But if I want to find out the PVIFA for third and fourth year, so what I can do is I can calculate the PVIFA of all these 4 years 10%. And from this, if I subtract these two factors, that means PVIFA up to 4 years minus PVIFA up to 2 years, you will end up getting PVIFA from year 1, 2, 3, and 4. Okay. Sorry. PVIFA for year 3 and 4. So similarly, to calculate the PVIFA from 11 to 20 years, what you will do is you will use the PVIFA of 20 years, and from there you will subtract the PVIFA of 10 years. So you'll get the present value of factors from 11 to 20 years. So what we will do, 30.6 will be multiplied by this factor, 5.650, and um, the remaining 23.1 will be multiplied by the difference of these two, 1.819. Okay, so you will get 172.89 plus 42, which is a total of 214, and it is less than 250. So the project is not viable as far as all equity is concerned. Okay, team, just give me a minute. And in the meantime, just write it down or maybe note it somewhere so that you understand what I'm trying to say. Okay, give me a minute. Yes, Steve. So is it clear?
Now the total present value comes to 214.9089. So we
Right.
will compare it with what? 250
250.
lakhs? Okay.
So it's
250.
minus 35.09.
Right. Okay.
And the project is not viable if we consider all equity. Okay,
Yes.
fine. Everyone,
Yes, ma'am.
this
Clear.
this concept is also clear. How do you find out the present value factor from in intermittent periods? So you go to the end and then you subtract the period from where you want it. So if I wanted, let's say, a PVIFA factor from year 6 to 9, okay, at a certain rate of interest. What I'll do is I'll use PVIFA for 9 years, and from there I'll subtract the PVIFA up to 6 years. So what I'll be left, or 5 years, if I want from 6, 7, 8, 9, then I'll subtract 5 up to 5 years. So what I'm left with is PVIFA of 6th, 7th, 8th, and 9th year. Okay. So this is what we are going to follow here. 5.650 is what we will use from 1 to 10 years. So 30.6 multiplied by 5.650. And uh, then you have PVIFA factor till 20th year is 7.469. So if you want the PVIFA factor from 11 to 20th year, 7.469 minus 5.650. So from 11th to 20th year, the present value interest factor of an annuity would be at 1.819. So 23.1 is multiplied by 1.819. It becomes 42. So total present value of the project is 5.172 plus 42. It becomes 214.91. Okay.
We
Which is much.
calculated cost of debt at 8%. Why did
I am
we?
coming on to that.
Okay.
So all equity, I have realized that this is not viable. Minus 35.09. Okay. So for all equity financed, outflow is 250 million USD and inflow is, present value of inflow is 214.91. So it's minus 35.09. It's not viable. Okay. Now let's talk about the debt. Because we are doing with adjusted present value, so we will find out the tax benefit separately. Okay. So how much is the loan? 150 million, right? At what rate? 6%. What is the cost of debt? 8%. And what is the tax rate? 30%. Is it clear?
Yes, clear.
Why? Because the investment is from the Nepalese government. He is offering us 15-year term loan for USD 150 lakhs. It's lakhs, not million. 150 lakhs with the interest rate of 6% per annum to be paid annually. So what will happen is we'll end up paying interest on 150 lakhs USD at 6%. So 6% of 150 lakhs is 9 lakhs, right? On this, we will get the tax benefit. So we will get a benefit of 30% on this. So every year we are going to save 2.7 lakhs USD, right?
Yes.
And this will continue for 15 years. Right? And cost of debt is 8%. Okay?
Yes.
So
It means
2.7 lakh multiplied by
Eight-
PVIFA, 8%, 15 years. The factor is
8.559.
given as 8.559. Sorry. So if you consider the tax benefit, 2.7 into 8.559 559. The tax benefit is 23.1093 on debt. Present value of tax shield on debt. Okay? So this is the benefit of leverage now. Clear?
Clear.
And if we consider initially we had a loss of 35.09, NPV was negative. So even after adding the tax benefit, okay, 0.11 I can say, we are still in the negative. $35.09 minus 23.10. So we are still in the negative of 11.99 lakh USD. So this means this project is not viable even after taking debt from the Nepalese resources government. Okay,
Yes.
so this project is not viable. Look at it again. How did we approach the question? You are setting up some road in Nepal for which the cost is USD 250 lakhs, depreciated over 10 years. You will be collecting USD 33 lakhs for 20 years. So first point that comes here is we have to segregate year 1 to 10, and then we have to segregate from 11 to 20. And a loan is available for 15 years at 6%. 12% is the all equity financing requirement. So first let's calculate the CFAT from year 1 to 10 and then from year 11 to 20 without depreciation. Multiplied by the PVIFA factors 172 and here PVIFA factor for 11 to 20 years. Adding the two cash flows, despite that we are still in the negative. So no, not worth. Now let's look at the tax benefit from debt. So 150 lakhs, 6%, 9 lakhs is the interest you will pay. Tax shield on that, 9 lakhs into 0.3, 2.7 lakh you will be saving every year for 15 years. And the cost of debt is 8%. So the present value of tax shield is 23.10 or 11. Even after the benefit of tax shield on debt, the project is still not viable. Okay. Let's continue the session. I want you to observe this data here. These are some MCQs which will be based on this data. So take 2 minutes to do some calculations like what it means is France will be receiving from Germany, UK, Italy. How much? 80 from Germany, 120,000 USD from UK, and 200,000 USD from Italy. So in totality, France will be receiving 400,000. Okay. Germany would be receiving 120 from France, from UK 80, from Italy 160, a total of 360. UK would be receiving from France, Germany, Italy 420. Italy would be receiving from France, Germany, UK, a total of 380. So total France will pay 480, Germany will pay 260, UK will pay 320, Italy will pay 500, a total of 1560 will be paid and received by the four countries. So it's a question on netting, multiple choice questions based on this on netting. So I want you to take 2-3 minutes to just do a little calculations here and then we'll discuss the MCQs on it. Okay?
Okay.
Understood, team? What is the scenario here?
Yes, ma'am.
Yes.
All right. So now if I ask you some questions like how much France has to pay or Germany has to pay, whether it has to pay or receive, whether France has to pay or receive, whether UK has to pay or receive, Italy has to pay or receive. Can you do that calculations?
Yes, ma'am.
All right. And this will be a unilateral or a multilateral netting.
It will be a multilateral letting.
All right. It will be a multilateral netting. But before doing a multilateral netting, is it necessary to do a bilateral netting also? The answer would be, all right, let's ask the first question. The treasurer of a US parent company is suggesting that if you apply multilateral netting system, company can save a lot of transfer or exchange cost. So the company's board of director agreed with the treasurer's proposal, but before applying a multilateral netting, it is necessary to apply a bilateral netting. Okay? Why? If I apply a multilateral netting, what I say is a total of 1560 is to be received and a total of 1560 is to be paid. So it will become zero ultimately. But you have to do it on a specific company level. So France and Germany, France and UK, France and Italy.
Yes, ma'am.
So the total that France has to, we have to see that France has to receive from Germany 80 and Germany
$80.
from France 120. So when you are doing this, you will know that 40 is to be paid by France to Germany. Okay. But we'll do a multilateral netting, but first is important to do the bilateral netting also. Next, through multinational netting, the total transfers will be reduced to how much? If we do the multinational netting, the transfers will be reduced to how much? At present, what do you see the transfers? 1560, right? $15,000-$60,000 are to be paid and $15,000-$60,000 are to be received. But if you will do the multilateral netting, how much will this figure be reduced to? How much amount will be finally paid or received?
100,000.
How much? Yeah, I think I got the right answer. Please say it
100,000.
again.
100,000.
Okay, let's see. I think that's not the right answer. Let's check.
Ma'am, we will do, ma'am, single totals less. 400
Right.
minus like that, no?
Hmm. So France has to receive 400, pay 480. So France will pay 480 minus 400. France will pay 80. Similarly, Germany has to receive 360. Germany has to pay 260. So Germany will pay 100. Similarly, UK has to receive 420, but UK has to pay 320. Okay, so UK will receive 100. Italy will receive 360, 380, pay 500. So Italy has to pay 120. Okay, so either take the receivables 200 or take the payables 80 and 120, 200. So 200,000 will be exchanged net, not 1560. Got it? Another way to do is don't look at plus and minus. 400 minus
Yes,
480,
we will take, no?
80. 360 minus 260, 100. 420 minus 320, 100. 380 minus 500, 120. Add all four, it becomes 400.
400.
But 400 is payments and receipts, both. So divide by 2. 200 would be the net transfer. Okay? Because if you start thinking whether it has to pay or receive, it might create a little confusion. So simply you can take the differences of these four and these four individually And after that, taking that individually, add that and divide by 2. So the net transfers will be reduced to 200,000. Net receipts for France after netting? France,
40.
80.
40 plus 40, 80, ma'am.
80. You simply take from here 400 and 480 receipts. So France will be paying 80. Here also we are seeing minus 80. So France pays, net payment for France would be 80,000. Payment, not receipts. Net payment or receipts for Italy. Now this you will tell me. Italy.
$120 receipt, ma'am.
Receipt,
Yes, ma'am.
pay 500, receive 380. Payments are in columns, receipts are in rows. 380 receipt, 500 pay. So net
Sorry, sir. Payment, ma'am.
payment, net payment of 120.
120.
Right? So this is how you will do the questions on netting. Right? All right, team. I tried my level best to explain everything related to this. One more question is this. I think you will try to do it. If the transfer charges are 0.0%, how much you will save? So if instead of 1560, you are doing the process in only 200, you are not transferring 1360, and 0.01% of that, you will end up saving $136. Thank you so much. I hope you will be able to manage the questions on international financial management in the exams. All the best. Thank you.
Thank you, ma'am. So much.
Thank you. Thank you. Thank you, Ashishji. Thank you, everyone, for your support. Ashishji, we can't hear you. You are on mute, I guess.
Yes,
We
madam.
have completed
Yeah.
this chapter.
Yes, we have completed the chapter. And thank you very much, madam. When we were taking the MCQs, even I was also trying to MCQs. That's why I had put my mic on the
Okay.
It was a very encouraging exercise in the end. So, student, with this, we have come to the end of the topic of foreign exchange exposure, risk management, and international financial management. As I told you in the last class, this was the main portion that are related to foreign exchange. So, I think with this, we have covered a lot of major portion of our syllabus. Now, in the next class, we shall start with the interest rate risk management. That is another part of the risk management. Of course, as the foreign exchange is important, interest rate risk management is also equally important because interest rates matters a lot. So with this, we come to the end of this session and revise whatever we have discussed in this class as well as previous class. And if you have any query, you can send us through the mobile app as well as you can send us through the email. Madam, just write down our phone. I can just give first contact number 3045 956 and our email ID is sfm-final@ICAI.in. Madam, just write F again.
This F?
Yeah. Thank you, ma'am.
Welcome.
Thank you very much for your
Thank
making
you.
it interactive and have a nice day.
Thank
you.
you. Thank you. Thank you.